gonna get going. Today is our session on income statements and cash flow. And we have our very special guest who also works at the Office of Entrepreneurship and Innovation, Cari Humphry. And for those of you who don't know Cari, you should get to know Cari. She's the Marketing and Creative Service Director for us. And we like to call Cari a unicorn because she is extremely talented. I'm gonna drop a link to some of her artwork. Not only does she do like graphic design, she's a great painter. She's started her own small business, so she knows what it's like to be out there on her own. But she also has an extensive knowledge of accounting and finance information that benefits not only our office, but everyone who works in our office. And today it's going to benefit you because she's really great at taking what can seem complex or maybe a little hairy, right? And boiling it down into what you need to know and what you need to do. And so I'm really excited that she's here, and we're going to welcome Cari. Cari, thanks for being here.
Thanks, Stacy. You're too nice. And I think Stacy's got a few little like polls to start off with for you guys to fill out. And I am just trying, I'm excited about this because my degree is in accounting. I worked for Deloitte & Touche right out of school for just 1 year. Then I worked in public accounting for a local CPA for 4 or 5 years. I've been in nonprofit accounting, etc. So for as long as I could stand it. But so accounting is kind of one of those, and financials are one of those, I feel like, necessary evils. We all want a a good handle on it, or an understanding. But I think that it because if you're not doing it on a regular basis, it can seem like a foreign language to you. So I'm kind of looking at some of your feedback on why you're attending this workshop, which I wanted to know, like who's in the room, or if this is a room, I guess, who's online. So I'm looking at most responses are, I think it's valuable information to learn. So yes, reiterating that we know it's valuable. Some of you feel lost when people talk about it, and then you might even have like aspirations, as at least 4 of you do, to start your own business someday, and you see this as foundational. And so I want to applaud all of you. Yes, if you feel lost and you want to have some confidence in this area, all of your responses indicate that you understand that this knowledge is foundational. And I would say it has application across, your life. So personal application to your personal finances, to your, if you want to launch your own business, freelance, if you want to, work in an industry or for a corporation. These are just kind of, this understanding is invaluable. The problem is it's kind of dry and boring. So a lot of people, I think, get throughout their academic career, especially, and even into the workplace, and don't even get a full grasp on this. So my goal is just to like somewhat plant the seeds in these main primary financial statements. And so you can see how they connect and how they would connect to you in whatever trajectory that your career, or that you hope it will take you, or where you find yourself now. So I'll share the results with y'all so you can see those. Stacy's introduced me to these polls. So yeah, you can see majority of you valuable to learn, but there's definitely several of you that have a startup or a business and feel just not confident in it. So there was one more poll to get started, and I'm going to get to the next screen. I think Stacy's helping me with the polls. Okay, understanding around financial statements.
Yeah, the whole question doesn't fit there, but it's, what is your level of understanding around accounting and financial statements?
Okay, this is good. So you should all feel good about this. So no one feels like they could teach the workshop themselves, and that's nice. That takes the pressure off of me. So there's no one on this call that's just checking me. But in general, it sounds like a different language to the majority of you. So you've been in conversations, whether it's about business, career, your startup, and people start saying words that you don't know what they're talking about. And that's kind of where my goal is, just to get you from a place of not, to move you forward in your confidence level. So I'm going to share this. I think we've got everybody answered, and I'll hit share there so y'all can see what the rest of the participants said, and then we'll get started. Yeah, Stacy said my background is, I gave you the overview of my accounting background, but here we go. I'll delete that. I also do have a kind of a side gig where I paint and sell online and fulfill orders. I had a small business, my own like brick and mortar shop, for about 7 years. So it's kind of, you could find yourself in different places throughout your life. And I would say this foundational understanding is helpful no matter what job I find myself in. So, all right, we're going to start off. And I've got a few questions that are like polls. And then I also have, okay, here we go. Is that right? Yes. I also have, feel free, like, chats. I know if Stacy's going to help me watch that if a question comes out, but I also have some like designated times that I'm just going to stop and say, hey, let me know if you have any questions. So feel free to do a chat or raise your hand or just say, hey, interrupt me. It's completely fine. So I'm trying to use my left and my right brain here. And what y'all are looking at right now is just kind of an overview of these basic financial statements. So I like to think of this first one at the top, the balance sheet, as like a snapshot. So everybody's got a phone that you take pictures, you take videos or whatnot. A balance sheet is like a still photo. Think of it like that, of a financial position. So that word just means like, so personally, if someone were to take a picture of your finances on a personal basis, if I took a picture of Stacy Burley's finances, it would list like what's in her bank account, what car does she own, like at this exact moment. It would be Stacy's finance position as of what's today, October 7th, 2021. Yeah. So, and it would list all the things about Stacy financially, things she owes, things she owns, things that, her assets, her liabilities, and any kind of like extra equity she might have. So this is the formula, and y'all have probably all had some kind of algebra class. The formula of a balance sheet is your assets, which the word asset means, asset's a good thing. Assets are things that you have. So Stacy's assets would be her bank account, would be her car, would be her house. So those are assets. So assets on a balance sheet equal your liabilities and your equity. So Stacy's liabilities would be what she owes on the car, what she owes on her house, and if she owes anybody else anything. So if your assets, let's say, are $100, your liabilities are $50. So you owe $50 on that car, or you owe, I mean, that's just in a dream world, obviously, but you owe $50 on a car and you don't owe anything on your house. So her assets are $100, her liabilities are $50. So that means it's almost like equity in a personal situation is like is like X if you were doing algebra. So Stacy has $50 in her equity section personally. So you can see on a personal level how you can have a balance sheet as a person. On a business level, you're going to have a balance sheet that is going to list all the assets of the business, all the money that the business owes, And the equity section is a lot of time owners might have put their initial investment, but it's the difference between the assets and the liabilities. So these sides of the equation always equal out. So so balance sheet is this snapshot. The income statement is actually, and I'm going to show you all on the next slide, but the income statement is a period of time. So maybe typically that period of time is like 1 month, like January 1 through January 31, or it's a year, January 1 through December 31. And so it's like actually activity during that year. And it is just like normal activity, income or expenses if you were a business. But I like to think about it personally, because we all have context personally. Your income statement on a personal level would be all of the money you made during the year and all of the money, and then your expenses you have. So you could make a personal income statement. And I like to think of an income statement as kind of being a movie. Okay, so like if you have like this picture at the beginning of the year and a picture at the end of the year as your balance sheet, like if you were recording the video throughout the year, this is what happened through the year. And this is all of the totality of all these income and everything, but it's a record of that throughout the year. And then we have this third statement, which is really useful, but I would say it's like a movie, but I'm going to call it a documentary. So the cash flow statement is really similar to the income statement, except for it takes out all of the it's like edited. It takes out, or it's not edited is what I mean. It doesn't have anything that didn't actually happen in it. And that sounds weird, but it doesn't have any cash, like all the non-cash transactions are taken out of the income statement, and it leaves you with a cash flow statement. So I kind of think of that as like a documentary. It's like uncut. It's like, this is like the reality of what happened. And I think I'm going to show you how these three statements are connected. But I like to think about like the cash flow statement as being just reality. It's like the nitty gritty of what went on. Okay, so here's this is how these three main statements are connected. Okay, so here at the top, you can see we have a balance sheet as of January 1. And then look over here, I have this little balance sheet listed over here, December 1. I've got some animation on this. Let me see if I can make it work. There we go. Okay, a line showed up. Yay! So the activity would happen from January 1 to December 31 is what that line represents, okay? And you can see right there in the yellow, I listed out that same formula I was telling y'all, that your balance sheet is your assets, which in a business, we have other things than maybe as a personal, like Stacy probably doesn't keep inventory of widgets or something just for fun. So there's no reason personally for Stacy to have inventory. Now, if you were starting your business off and you were let's say you were an artist and you might have some inventory personally that you want to include on your personal financial statement. But this is more, from now on, I'm going to be kind of more talking about business, like a business context. So a business would have a inventory listing if they track that. They would have accounts receivable. They would have equipment. These are all like assets that they have in their possession. If they lease a building, that building is not going to be listed as an asset. If they own the building would be listed as an asset, even if they owe money on it still, because then you can see the liabilities down there, and then you can see that equity. So what happens from January 1 to December 31 is the activity that we actually get recorded on the income statement. Okay, and so then you can see what the income statement is. Many of y'all probably have seen an income statement, but the income statement just consists of, these are the sales that the business made. Also, if it's a nonprofit, they might get some donations. It does not include loan proceeds. So let's say the business takes out a $10,000 loan to start your business. That's not revenue. Okay, so that's an exception. These are like actual earned income. And so you made a sale, or again, if you're in a nonprofit, even though donations aren't earned, that's kind of in your normal line of business. So yeah, an income statement has revenue at the top, takes out cost of goods sold. Not every business will have that section, but if you are selling an actual physical item, you can kind of take out the costs of that physical item, and it gives you the word net profit. And many of y'all have probably been in a conversation where somebody talks about net profit versus net income, and you think, I don't know exactly what they mean. So the net profit, or the profit margin on, let's say, a item, maybe you're going to make a cup of coffee. You've got a coffee shop, and you sell the coffee cup, 1 cup of coffee for $2. And the actual cost of the coffee, and maybe there's creamer in it, and the actual cup it's going into are in your cost of goods sold. So each one of the net profit or the profit margin on each cup of coffee is maybe, a dollar is the expense, the cost of goods sold, and you sell it for $2. So you make $1 for every cup. That's what net profit means. And net or profit margin. The operating expenses are going to go down below the line. So if you have this coffee shop, the things that would be in that section on the income statement would be things like utilities or payroll to your people that are working at the coffee shop, things that are bigger than just the actual product you're selling, things that apply to your whole business. Maybe advertising, that would go in the operating expenses. And then that gets you that net income number that you've heard people talk about. And so again, this income statement, let's say we're looking at an income statement between 2 different balance sheets from January 1 to December 31. Typically, people produce an income statement for a period of time, and they produce 1 balance sheet that's as of the same date. So if you are going to start your business and you want to take out a loan, they might ask you for financial statements, or a cash flow. If you have already operated your business for a little while, like maybe a year, they'll say, hey, can we see what you've done so far? And you would give them an income statement that would be from a period of time, like January 1 to December 31, and you'd give them a balance sheet that was as of December 31. So these 2 statements are read together. They can see your financial position, your assets, your liabilities, but they also can see the activity that went on throughout the year related to your business. So how these are all connected, then we have the cash flow statement, which a lot of banks like to see, and it's actually a really useful tool. So a cash flow statement is really similar, like I said, to the income statement, but it takes the beginning cash balance from January 1, and it's just cash. It doesn't take your inventory or your assets, and then it adds net income from the income statement, this bottom line, net income, and then it adjusts for non-cash activity. So this little circled part right here, I have a question. Stacy, I think we have another poll here, maybe. Yes, what do you guys think is, out of this poll, is an example of non-cash activity? This one's kind of, I don't know if it's hard. Y'all are pretty smart. We're close. Okay, I'm just going to share the poll. And then we will talk about a few of these. Okay, so non-cash activity. I gave you 4 options. So this was, I'm going to say this is the hardest question. So let's talk about what's not cash. A refund to an unhappy customer. So you just kind of have to ask yourself, does cash exchange hands here? So if you refunded an unhappy customer, there's money that comes out of your bank account and goes back to that customer. So that's actually a cash transaction. So A, or the first answer is not correct. So paying interest on a loan. When you make a loan payment, you're going to pay a little bit principal and a little bit interest. There's something called an amortization schedule that kind of spreads that interest out depending on your rate and the timing. But anyway, part of your payment is interest. So a part of it's principal and part of it's interest, but there's money that comes out of your bank account and goes to the bank or to whoever you borrowed the money from. So that's actually a cash transaction. That's included. It's part of your cash flow. You know, it comes out of your bank account. Borrowing money from your dad. This one was sort of sneaky, but it's for your business. So there's actually money that your dad gives you that you put in your business's bank account. And then you would also record a loan, if you're doing this correctly, on your liability. It's a cash is exchanged hands. So the last one, receiving a bill for utilities that is due next month. Okay, so if you receive a bill and you don't pay it, it's not due yet. That's the only thing on here that is not a cash transaction. So you just really received a bill. You can record it. You can actually record it as an expense and as a liability that you owe it the next month. So the correct answer is the very last one, receiving a bill for utilities that's not due now, it's due next month.
Hey, Cari,
yeah.
Asked, what about like
Yeah.
accounts payable in this?
Yes, that's exactly right. So Alexandra, or Allie, the bill that you get, the bill you get actually goes, you can chart, there's something I'm going to show you on the next slide, I think. It's called a T account. So you receive that bill and you're going to record that, maybe it's a water bill. You're going to record it as a utility expense on one side of the transaction, and the other side goes to accounts payable. So it is actually a non-cash transaction that we will adjust for. So things that hit accounts payable are non-cash transactions. The other thing I didn't point out here is things that hit accounts receivable are non-cash. So let's pretend you have a friend that loves to drink coffee and you have your coffee shop, and that friend comes and says, hey, look, I never have my debit card and I don't have cash. Can you start me an account? And you're like, okay, sure. You do it for her. So every time she gets coffee, you let her buy it. You give it to her. You make the sale, but she doesn't pay you. You put it on an account, and that's called an accounts receivable. And you can see that over here on this yellow tab here, the assets. Accounts receivable are an asset. So that means you made a sale, but you didn't get money. So no cash. That's a non-cash transaction too. Somebody owes you money. And it's the same way with a bill you get, that you get the bill, you now owe somebody money, but you're not paying it till next month. And you hope your friend pays it next month too, but you record it. And that's what the cash flow, you take all of those things out. You can see that on the green, you adjust for that. So given, here, I'm going to stop sharing. Given what I've kind of explained, oops, let's get this off. About this connection. First of all, like I'm going to say, are there any questions? I mean, Allie, that was a great one. Accounts payable, and then the other side of that's accounts receivable, and those are non-cash transactions. You're exactly right. Any other questions about what that connection I just showed you? And if y'all don't have one, I have one for you. I think I do. Maybe it's on the next one. Okay. So this is what we're going to look at really quick, and then we'll go into the cash flow. And I've got like a set, kind of an example one that's really simple that I hope is interesting enough that this doesn't get too boring. How many of you guys are in a science discipline? Just kind of raise your hand on the app or on the Zoom.
Yeah, or
If you're,
put it in the chat here. Yeah, raise your hand.
yeah, or put in the
Yeah.
chat. We've got Josh's. I feel like somebody's going to correct me on this, but there is a, there's like some scientific properties where there's a, what's the phrase? Like where there's a force, there's an opposite force. How does that cliche go? And, you know, it's not even a cliche. It's an actual, like, I think, like where there's an equal and opposite force. What somebody
For
put that in?
every force, there's an equal or opposite force, something like
Yeah,
that.
there's something like that. What's
A
that
law of
saying?
physics.
Yeah, law of physics. Thank you. I'm pretty sure that's it. But again, all the science people correct me. I can that's not my it's not my area of expertise at all.
I think it's Newton's third law.
Thank you.
Yeah.
Yes.
For every
Okay.
action, there's an equal or opposite reaction.
Yes,
Yes. Thank
okay.
you, Marcus.
Thank you. Yes, yes. So that was what I was looking for. I knew there would be some science people in this workshop. So when you were thinking about accounting, remember Newton's third principle, right? Or third law. So for every action you take on one side, there's an opposite side. So every event has two sides to it. And so in the accounting world, they call this a T account. And this is like old school here. And I'm just apologizing. Like wrote on this with my mouse. I have much better handwriting than this, but this T account is where is a good visual in your mind. And this is how balance sheets and income statements are actually created. They are created by like individual little transactions that create this total number, which is like a whole balance sheet or an income statement. So like you have a series of transactions that you have to account for to even create a financial statement. A lot of you might get an accountant to help you with this if you're launching your business, but understanding what each transaction does and how it impacts your financial statements is really key. Even if you're not going to keep up with each one of these, you might have an accountant or hire an accountant or work for a company that has the whole accounting office. It's helpful to understand this. So to start off with, these are some examples of some things that happen. And you can see when these things happen, how they impact the financial statement. So, oops, I clicked, sorry. So here at the top, if you have a sale, we sold a cup of coffee, and you can see over here on the far right, I kind of gave an example of these T accounts. So when you sell something, you're going to have two sides to that transaction. So, okay, I put 500 up here. Let's say you sell 500 cups of coffee one day to a group. They're hosting a conference. So you're going to have the words debit and credit is actually, you're going to hear a lot of that. And I'm just going to call out anybody in the banking industry right now. Bankers don't understand this, and they actually say it backwards because on their side of it, it looks good. So we all think like, if you were going to say, hey, I want to debit my bank account, you would think that was like a bad thing, right? And you think a credit is a good thing. Do we think about it like in that way? It's like if somebody said, I'm going to credit your bank account, don't you feel like they're going to put more money in it? I mean, I know that I can't see most of your people's faces, but that's sort of the language, that's the common language that people use is like, oh yeah, I want a credit to my account. That is actually kind of the opposite of what you're really doing from, the financial side. If you're going to increase an asset, so remember that balance sheet, the yellow section we looked at, you increase an asset, you are actually going to debit the asset. So every transaction that happens in a business, it doesn't matter what business it is, it has two sides to it. It has a debit and a credit, and they have to equal each other, just like Newton's third law. So you can't debit your bank account for $500 and then credit The sales account, which y'all can see that's the first thing, you can't credit that for $300. They have to equal each other, or your balance sheet and your income statement, none of it will tie together. It will be inaccurate. So you can see this first one, these T accounts just show you, this was kind of like the old school way to make sure you were doing this right. You would say we were going to debit our cash account when we made a sale. And so that means we're increasing our asset, and then we're crediting sales. So that hits the income statement. So these are two different statements you're working with, the balance sheet and the income statement. You're not touching the cash flow. The cash flow statement is generated from these two statements. So that sale increased your assets with a debit, and it actually increased your revenues with a credit. They kind of work opposite of each other. So that's a good thing, right? What if you take out a loan? It sounds like a good thing. So what happens on a loan? We're going to actually increase our cash, right? Money came into your bank account because you borrowed it from a bank. But then you're also going to increase something else. You're going to increase a loan on your balance sheet down there as a liability. So Allie pointed out accounts payable. Accounts payable are like loans. You know, they're like, well, I owe someone money. They're in the same section on the balance sheet. So you have increased a loan to the bank, but yet you put money in your bank account too at the same time. So that's the two opposing forces, or the two journal and two entries to that transaction. An invoice, I gave you an example of when you got the invoice. This is the third one on this screen. When you got the invoice and you didn't have to pay it, you didn't have to pay it till next month. You might record it as an expense and then put it, and also the opposite side of it was you would record it as an accounts payable. This example right here, let's pretend you get an invoice and you have to pay it right then. Like there's no wait time, you need to pay it right then. So you would actually, it's coming out of your bank account, which is a credit. And again, I know that sounds so crazy because that is not how bankers talk. But if you're going to credit your bank account, your cash account, that is a subtraction in the accounting world. And then you're going to increase an expense. So it's a bill in your coffee shop. It's a bill for advertising. Maybe you advertised on the radio. So you got a bill, you had to pay it. So your bank account went down and your expense, your advertising expense went up. And so they're for the same amount. Now, y'all are really smart. And I know if you are math people and science people, you can make these transactions can be way more complicated than what I'm giving you. So you could have an increase to your bank account, and you could hit the other side of it can hit multiple different accounts. So I want you guys to know that, like, even though they're equal, each side of that T account has to equal out. It doesn't have to all be in the exact same account. Like, your bank account could go down and you could actually write one check for multiple different types of expenses, so I'm just giving you some simple examples. And I want y'all's help on this last one. This is the purchase of a piece of equipment. So we have our coffee shop. We bought a new espresso machine. What happens to, we know what happens to our cash, right? Our cash goes down. This espresso machine was like $5,000. Our cash has hit $5,000. That's the credit. What's the other side? Yeah, there we go. We have a poll question. Yay. What's the other side of that transaction? I'm watching y'all's answers. All right, I'll just, I'm going to end it and I will show you guys. Okay, so it's really close to 50-50. So we have bought a piece of equipment. And so we are going to subtract it from our bank account, which is an asset. And we're going to actually, the other side of it, the correct answer is debit and asset. So we're actually going to increase our equipment, right? So this one's kind of a funny transaction. They both happen in the asset section of the balance sheet, but your cash goes down, but your assets stay overall, they stay the same because you have purchased a piece of equipment. Now, I mentioned at the beginning of this that what if you rented that espresso machine? If you rented that espresso machine, and maybe it's $5,000 a year to rent this espresso machine, and you had to pay $5,000. We don't have a poll question here, but I'll go ahead and tell you all the answer. If you were renting it, your bank account would go down $5,000, and you guys who guessed expense, the expense would go up $5,000 because you don't own that machine. You're renting it, and you would charge that to equipment rental, which would be an expense on your income statement. So whereas if you purchase it, it just keeps your assets all the same. You know, you moved it from cash down to equipment. If you actually rent it, your cash goes down and your expense goes up. So, you know, it depends. Obviously, rent or buy is a business question, and understanding what it does to your financial statements is something that should play into your decision whether to rent or buy a piece of equipment. Okay, I don't know if I ever shared results. Okay, sorry. I think did y'all see that? So it was pretty close to being split. Okay, let's see. We're gonna move on from this. So this kind of just is an overview, really general, of the debit and credit system behind financial statements. So every transaction, your new business or the business you work for, or even the university, every transaction the university does, there's two sides to it. And so things that, you know, you feel like this is all good, yay, I made a sale, but if they didn't pay for it, then you've got to collect the money. So you just kind of have to understand how all of that's working. When you are going to borrow money from a bank, they care about those things. Okay, so before we move on, we're about to do our little sample set. Does anybody have any questions about those transactions, the equal and opposite force? I can't see the chat. Are there any in there?
There's no questions in the chat right now, but as we keep going, guys, feel free to drop those in.
Yeah. Okay, so this next section, this is a question. This is my last question. And this one, I hope I've given you enough information that you can answer this one. And I think, is this a poll question, Stacy? Yes, okay. Out of the three financial statements, balance sheet, income statement, cash flow, all of you guys, I hope, know what a check register is. I know it's kind of old school because everybody debits things and you go online and look at it. But once upon a time, people used to write checks, and there was this register that you would record those checks down in. So which financial statement that we've talked about, do you think is the closest to a check register?
Hey, Cari,
Yeah.
do you have the pull up? For some reason, it's not pulling up. I'm not.
Oh, maybe I'd had to. Is it pulling up now?
No. So we may not be able to do this one.
Oh, it says fail to share poll. Another poll started.
Yeah, it's weird.
I don't know. Okay.
So we're gonna
maybe just put your answer in the chat. Which one of those three do you think is the closest?
And the three choices are, yeah, balance sheet,
income statement, or cash flow.
Can you see those coming in, Cari?
I can, yes.
Great.
Okay, the good thing is you guys are well, I mean, we do have a variety here. But there is a lot of, the correct answer is that documentary is the cash flow. So the cash flow has no non-cash transactions on it. So think about it. That's what we talked about. We're going to pull out all those non-cash transactions, the things like I owe someone money, but I don't have to pay it for a month. I have this, or someone owes me money because I sold them a whole bunch of coffee and they haven't paid for it. We're going to pull all of those out. The things that don't hit your bank account are actually, that don't have any cash impact, are pulled out of a cash flow. So think about it on the name of it. The cash flow statement is the closest thing, should be the closest thing to your business or your own personal check register. Okay. Let's see. Yes, thanks, guys. That was, we don't know, the poll had a mind of its own. Okay, why do you need a cash flow? And I mentioned it already. It's reality, and I say versus theory. There's a lot of things, especially the more complex your business is, that you can accrue for. So that word accrue is, we've already talked about accruals. And you guys probably didn't know it, but if you've heard people say the word accrual and you just nod like you know what they're saying, they're really talking about things like accounts payable and things like accounts receivable. They're talking about recording things that you either have earned or you have already spent, like you have spent up the electricity in the building, but we don't have to pay that bill till next month. That's an accounts payable. That's called an accrual, meaning like we're recording it as an expense, even though we haven't like paid it yet. So banks and stuff, this next one, look at your actual liquidity. They look at, so the word liquidity is like, what's the ratio between your assets and the kind of the value of your business? Like you can have a lot of assets, but if you owe more money than all of your assets are worth, then you have no liquidity. You can't sell your business and have any like equity in there. So your equity would be like negative if you think about it. If you owe more than all your assets combined. So banks who want to loan you money or investors, they care about that difference between your assets and your liabilities. And a cash flow speaks to that. Like, are they actually cash flowing? There are some business startups that like they try to launch and they have a lot of promises and they even have a lot of interested investors or interested early adopter customers, but they don't have any actual money coming in. And banks care about that. They want to know you can pay them back. Projections are like my favorite thing. This is why you will use the cash flow. And that's why the cash flow statement is one of the most useful tools for your business, is to manage your cash, to know I can pay my bills when I need to manage when my income's coming in, to make a long range plan and say, look, I mean, there's some great, I love to make like a 5 to 10 year like Excel spreadsheet. Whereas like if you could just increase your sales by X%, how that impacts your whole cash flow bottom line, and you can see your business growing. Projections are like an excellent tool or an excellent, result of a cash flow, and understanding that. So like I said, enlisting investors, obtaining financing, those are great reasons why you need a cash flow. And it is a really, really handy tool for most business owners. I'm going to go really quick on this sheet because I know we're getting close to time. There's two ways that there's cash flows. There's a direct method and an indirect method. Both of them are acceptable to banks, and there's a word called GAAP. And GAAP is sort of like, I would say the NCAA is to athletic sports. GAAP is this like oversight in the accounting financial world. It's the general accepted accounting principles. That's what GAAP stands for. Both of these methods for a cash flow are like deemed okay by GAAP. Most small businesses use the indirect method, and we're going to talk about that really quick. So the direct method, I would say, reflects literally your check register. So it's kind of recreating your check register is pretty much what the direct method is. The indirect method, why people like the indirect method, small businesses, is because it's a little bit more efficient, and it's quicker if they have generated an income statement. So I think it's simpler in the long run. Sometimes if you don't have a lot of transactions, it might not seem as simple, but here's my fake coffee company. And I totally plagiarized a logo that I liked online. So full disclosure on this recording, I just popped one in there. I grabbed it off of Google Images. But this is a coffee shop. And these are two statements here. We're looking at an income statement and a balance sheet. And we actually have, I would say, two balance sheets here. I highlighted it over on the far right. Here's the balance as of 1/1 on our balance sheet, and then the 12/31 balance. And then you can see the income statement as of 12/31. So if you're looking at this coffee shop, they had $25,000 in coffee sales, and they had $14,000 in food sales. They ended the year with $19,000 in their bank account. So now you're going to shift your brain over to the balance sheet. You want to see what's in, not 19, 13,000. What's in their bank account at the end of the year is 13,000. They have here, you can see the cost of goods sold. This is how much their coffee costs were. This is how much their food costs were. Their net profit off of their main product they're selling, their net profit right there, you can see is the 27,500. Then there's all these expenses that are operating expenses below that line. So this is just one I made up last night, trying to use some big whole numbers. So you can see they had all these expenses and their net income for the year was $10,000. Okay. We're gonna go back to that really quick. I'm gonna tell you these things. So the cash flow statement has three sections, pretty much no matter which way you go, indirect or direct, but you think about things as far as operating activities, investing activities, and financing activities. These are all like general business transactions. And so the cash flow statement, just kind of like your bank would want you to separate them in different sections. You don't have to for your own internal use. Just do what makes sense. But like, this is kind of the standard normal business activity, selling coffee or whatever, that's operating. If you purchase property or you invested in another like kiosk in a mall with your coffee, you know, that someone wanted to run, that would be kind of like, oh, I'll give them $5,000 and they can do that. Financing activities would be like how you are obtaining investors or loans. So GAAP, general accepted accounting principles, likes to group things in those three categories. Not super important. I kind of think about it all as one big lump. And then if you have to make a statement for a, you know, an outside organization, you might break them into these categories. Non-cash activity, we've already talked about it. You're going to add back things that don't hit your bank account. It's really that simple. And so you kind of just have to ask yourself, what are those things that actually don't touch my bank account? You might have heard of the word depreciation. If you own that piece, you bought that espresso machine for $5,000. In 5 years, that espresso machine isn't worth $5,000 because it's 5 years old, it's crusty, it's been through a lot. You probably won't be able to sell it for $5,000. So there is a concept called depreciation, which means each year a business is allowed, so it's kind of a good thing, because like keep in mind, even though you want to make money at the end of the year, you also don't want to pay taxes on all of that money. So it's good to capture some of these non-cash expenses. They're to your advantage and the IRS allows them. So you could take $1,000 off each year off of that espresso machine if you think, hey, at the end of 5 years, I'm going to have to buy a new one. So you're going to depreciate it, and that's an expense on your income statement, $1,000 a year. You just spread that coffee maker out. So that's one kind of non-cash example that's one of the biggest ones that businesses adjust for. You do some other, like Allie pointed out, accounts payable, accounts receivable. Those don't touch your bank account, so you adjust for those. You actually take off your accounts receivable and you add in, you know, your accounts payable. So like, or the changes in them. So I'm going to show you that on this page. So we have this. Okay, here, this is what I want to show you. So I've made a cash flow from this. And I don't know if, I mean, I can share these slides with y'all if it's even helpful at all, but I've kind of drawn some lines where you can see how the cash flow is created from this income statement and this balance sheet. So at the very beginning, so just focus your eyes right now on the cash flow down there at the bottom, that very first line, you start with your net income. Super simple. This is why small businesses like it. Oops. I don't know why it keeps doing that. Sorry. Start with your net income. That I took the $10,000, put it right there. I'm going to add back depreciation. Why do I do that? Because that's not a cash item. Okay, so I have to increase my cash flow by that. That didn't come out of my bank account. That didn't touch my bank account. And then I also subtract my decrease in the bank loan. So this is the one that kind of can blow your mind, but you look up here under liabilities. Throughout the year, my bank loan went from $8,000 to $5,000. What does that mean? That means I paid off some of that money. I mean, I paid $3,000 off on that bank loan. That hit my bank account, right? But reducing a liability doesn't touch your income statement on this left side. So we actually have to subtract that $3,000 out. So our changes, I made these two simple adjustments. These are the only non-cash items that happened at this coffee shop throughout the year. So the total change I made was that negative $2,000. If y'all see that, that's just 1,000 minus 3 gives me minus 2. The total cash flow activity was 8. All I'm doing there is taking my net income at the very top of 10, and I'm subtracting the 2, and that gives me 8. So now you can test yourself. Did this work out? Did I capture all of my non-cash items? And you can look your beginning cash balance at $5,000 at the beginning of the year. My ending cash balance is $13,000. So is that difference $8,000? And if it's yes, that means you captured everything. This is an accurate cash flow. You know, you did it right. So they all tie together. There's a way to reconcile them as long as every entry has two sides to it, just like I said, and as long as you have these checks on yourself. So I am like 3 minutes away from the time. I am so sorry, Stacy. I told you, I'm like, it's so boring. I can't talk for that long, but I clearly can. So this leaves me, I can go back to this example and leave that up, but are there any questions that you guys have in the last 3 or 4 minutes?
Yeah, and real quick, I dropped the survey link in there. This workshop is also going to be with our others on the OEI YouTube channel. So I put the link to that. I'll put that in the follow-up email that I send, and I'll send these slides of Cari's if that's helpful to you all as well in an attachment. So, but we'll stay on for the next 3 minutes plus if people have questions. It's open to you all. And I will say before that happens, just because we'll lose people, a huge thank you to Cari for doing this today. Awesome presentation. And Cari is like a guru. So if you have questions, like ask her now or think of them and ask her later, but we'll open that up. Feel free to use the chat or unmute. It looks like we do have a question. Is paying dividend a non-cash activity?
Paying dividends. Well, actually, so it hits your owner's equity section, and that is a hard section to understand. It can be really simple. So if you have dividends to pay, you have investors or you're like selling stock. So it's kind of at a whole different level, but you actually do, your bank account decreases. So if you're paying out the dividends, sometimes dividends just get credited to like your equity. You might just have that dividend increases your stock, whatever. I mean, this kind of gets complex, but it can be a cash activity. I mean, I would probably need to look, there'd be some other pieces to that, but it would reduce your cash. and it would, so it'd be a credit to your cash, and it would be a debit to the owner's equity section of dividends. And a lot of people take, so what that whole owner's equity section, it's complicated. This could explode people's brains, but it's called another word for it's retained earnings. So that sort of makes more sense. In this example with the coffee, the net income, this $10,000 that they made, actually lands in retained earnings. Like, that's the difference there. It'll like rolls into retained earnings, and you carry forward the retained earnings of the business each year. Sometimes they're negative, sometimes they're positive. So when you're public and you've got stock options and you've got investors and you're paying dividends, you can do it in a few different ways. But typically, if you pay them, yes, it would hit your cash account.
Great. We also have another question here. Josh asked this one. So for cash versus accrual methods of accounting, I'm still not sure I understand why accrual is better in the long run. Could you talk a little bit more about why a small business would be better off with an accrual method of accounting?
I 100% agree. Cash is way simpler than accrual, and it absolutely depends on the type of business that you run, in my opinion. Accrual is a more accurate picture of what actually happened, and that is a lot of investors and or banks want to see an accrual basis. There is you can run your business off of a cash basis, and then you can make some big adjustments at the end for some accruals. A lot of organizations do that. They run their business throughout the year on cash. And so cash basis business would mean we don't record the sales to our friend who didn't pay us. We don't record them till she pays us. An accrual basis would also mean that, like, if you had employees working for you and you pay them on the 10th of every month for work they did the month before, if you're doing accrual, you would actually record that liability in that month. So accrual is more accurate in like recording the expense and the sale in the month it happened. So it gives you some good information as a business. So maybe your sales model, maybe you're selling widgets or coffee throughout the year, and you want to see some trends. If most of your sales are cash, then yeah, the cash basis works. But if you actually are having a lot of people, like your friend, pay on account, then your trend might not be accurate. Maybe everybody buys coffee in November and December because it's really cold, but if they're all paying on account, your bank account might not have gone up then. And so the cash basis might not reflect your business as well as accrual. But you're exactly right, Josh. Cash is simplest. Most small businesses, it is the easiest, and for a lot of them, it is a good enough picture to start off with. Are there any others? Yeah, I can stay on. So
yeah. That's what I was gonna say. For those of you who have to get off, we want to let you know it's 1:03, so you're welcome to drop off. Again, thank you for being here today. We love connecting with you. If you want to connect with Cari or I or anyone else in our office, I will send that contact information in a follow-up email, so look for that. But if you have questions and you want to hang out, Cari and I will be on here for a few more minutes, so feel free to stay on and unmute yourself and chat with us. Thank you guys, and thank you, Cari. Awesome job.
Thanks.